There's a charge on your bank statement right now. It averages $847 per year. You pay it every single month. And 94% of Americans have never once questioned it, not because they can't afford to, but because they literally cannot see it. In 2019, it was $12. In 2021, it was $23. Today, it's $70. It's not your rent. It's not your groceries. It's not even labeled as a fee in the way you understand fees. It's disguised as two innocent words that make it sound like they're doing you a favor. Monthly service. But this isn't a service. It's an inflation-linked wealth extraction tool. Banks designed it to grow faster than your salary, and you're funding it without a single question. You've been told that bank fees are annoying but harmless, that monthly maintenance is just the cost of doing business, that switching banks is too much hassle for a few dollars. Here's what banks know that you don't. They spent $4.2 billion on behavioral psychology research last decade, not for security, not for technology, for one purpose: to determine the exact dollar amount that extracts maximum money from your account while keeping you too comfortable to leave. They call it fee tolerance calibration. It's the science of making you feel just satisfied enough to stay, while systematically draining your wealth at a rate that outpaces inflation by 400%, while you worry about 3% inflation eating your purchasing power. This single service fee compounds at 15 to 20% annually, and it's been doing this for 5 straight years. Buried on page 47 of your account terms, past the arbitration clauses and liability waivers, lies a phrase that sounds bureaucratic, but functions as a blank check: operational cost adjustments. Banks don't need to notify you when they raise this fee. They don't need your consent. They simply reference rising operational costs, and the number auto increases. Chase calls it monthly service fee. Bank of America labels it maintenance fee. Wells Fargo uses account service charge. Different names, same mechanism, same blank check clause. Here's the mechanism they hope you never calculate. The $12 fee in 2019 didn't just become $70 through random increases. It followed a precise algorithm. Banks index these fees to their own internal cost of account management, a metric they control, define, and never disclose. At $70 monthly, you're paying $840 annually for the privilege of letting them hold your money. But here's the hidden extraction. If you maintain the average American checking account balance of $3,500, this service fee represents a 24% annual negative interest rate. You're not just losing $840. You're losing the compound growth of that $840 over 10 years, which is $2,187 at modest market returns. Internal bank documents leaked during a 2022 class action discovery revealed the pain threshold protocol. Banks calculate the exact fee amount where customer churn spikes. For basic checking accounts, that threshold is $75. Current industry average, $70. They're extracting 93% of maximum possible pain tolerance, leaving just enough buffer to keep you docile. They call this revenue optimization through inertia engineering. Your inaction is their business model. Sarah earns $62,000. She noticed her monthly service fee jumped from $25 to $35 last year. She told herself she'd switch banks when she had time. That delay cost her $420. But the real damage? Over 10 years, assuming banks continue their 15% annual fee increases, Sarah will pay $14,847 in fees alone. Money that, invested in a basic index fund, would grow to $38,200. She's not poor, she's busy, and banks weaponize busy. Marcus manages 3 accounts, his wife's, joint savings. Each carries monthly service fees. His bank quietly added a $5 paperless statement fee that wasn't there in 2020, then a $3 enhanced security fee. These aren't called monthly service, but they follow the same stealth increase protocol. Marcus pays $127 monthly across all accounts. Annually, $1,524. Over 15 years until retirement, $22,860. Assuming fees don't increase further. They will. Complexity is camouflage. More accounts, more extraction points. Linda's bank recently upgraded her to a premium checking account with a $45 monthly fee, triple her old rate. The upgrade was automatic. The notification was a single email buried in promotions. Linda's on fixed income. That $540 annually represents 2.1% of her Social Security. She doesn't know she can downgrade. The option requires visiting a branch during hours she's working her part-time job. By the time you notice, they've engineered friction to keep you trapped. 3 different lives. Same invisible mechanism. Same mathematical certainty. The longer you wait, the more they extract. Here's what no bank wants you to understand. This isn't your fault. You weren't careless. You were outspent on psychology research. But it's also not permanent. And it's definitely not inevitable. You were playing checkers against an opponent playing 4D chess, with billion-dollar research budgets. The game was rigged before you sat down. Switching banks takes 47 minutes. I've timed it. The average person believes it takes days or is complicated. This belief is marketing. Banks spend $8 billion annually on advertising that reinforces the myth of banking complexity. Credit unions exist. Online banks exist. Fintech alternatives exist. Many charge 0 monthly fees, not as promotion, but as structural business model. They make money on interchange, merchant fees, not customer extraction. The counterintuitive move isn't finding the best bank. It's recognizing that bank loyalty is a manufactured emotion designed to maximize your fee tolerance. Your grandfather stayed with his bank for 40 years. That loyalty cost him, adjusted for inflation, $34,000 in unnecessary fees. Your checking account isn't a relationship, it's a utility. You switch utilities when better options exist. The only difference? Banks have convinced you that switching is betrayal. It's not, it's arithmetic. But here's what terrifies me. The monthly service fee is just a visible tip. While researching this video, I started reading the actual terms and conditions. The 47-page documents we all click agree without reading. What I found in the fine print should be illegal. Arbitration clauses that prevent class actions. Data rights that let them sell your transaction history. Liability waivers that protect them when their systems fail. I spent 72 hours reading bank terms and conditions so you don't have to. What I found isn't just worse than you think. It's systematically designed to make you powerless while feeling protected. Subscribe with notifications. You need to see this before your next statement arrives. Because once you see the system, you can't unsee it. And they know that. That's why they hide it.